The company reported earnings this morning, and we are still trying to figure out what they mean. You've seen the numbers. You might not understand them, so we're going to find out as best we can what they do mean with one of the most accurate forecasters on Bank of America, Brian Charles, debt and equity analyst at RW Pressprich. Brian is right here. Brian, you and I have literally been looking over these numbers just moments ago because some of them just became available. Let's talk about the investment bank, and I'm putting this sheet down for both of us to see. We're trying to get a sense of how well Bank of America did relative to its peers because it's a really important consideration for 2011. So. Investment banking income looks pretty consistent with what they've had in past quarters, right. And pretty competitive with the rest of the street. However, if you stack up Bank of America against J.P. Morgan, either in fixed income or in equities, they seem to be trailing pretty badly. J.P. Morgan, the class of the street this quarter. What does that tell us?
Well, I'd want to take a closer look at exactly what the fixed income commodities and trading number was, and as well as the equity trading number. But at first, it's,
$1.8 billion is what it appears to have been for fixed income, $789 for equities.
Yeah, it raises a bit of a red flag, at least temporarily. I'd rather get some more color on the conference call to see if there's some sort of position that they took relative to interest rates that might explain the final results. But that's one thing I'd want to get aside just for fourth quarter numbers. Looking further ahead, I guess I am still optimistic on the company. I do think that they have market positions that are going to put them at the top of the league tables going into 2011, 2012. And when looking at the other problems that the company's facing right now regarding mortgage putbacks, I don't think they're out of the woods there, but I think they got the scale to manage what those ultimate losses may be.
Let's talk about the putbacks, because Moynihan, when he was here, at least on the screen just moments ago, told me that the GSE issue is behind Bank of America, which is to say that the $4.1 billion in charges that they took for mortgage-related rep and warranty issues takes care of the whole GSE problem. In other words, it's bigger than the $3 billion that they warned us about a few weeks ago, because there's more in there now.
Right.
Do you feel more comfortable about Bank of America's exposure to the mortgage industry and the potential downturn in housing now than you did as a result of that?
Well, when all said and done, this wasn't entirely unexpected. The agreement that they reached with the GSEs that they announced in early January really took care of the outstanding pipeline of claims from Fannie Mae, but not all of the potential claims. So this additional provision may be associated with that, but the additional reps and warranties provision, as well as litigation expenses, might also be devoted more toward private label.
No, he said private label they haven't even tackled yet, nor the monolines. That's to come. They're starting to deal with the monolines right now.
All right, good enough. Then if this additional provision is associated with the GSEs, that's pretty much what I thought the additional exposure could be.
Okay, let's talk about the balance sheet. Brian Moynihan has said in the past, I think most recently on the third quarter conference call, that he wanted to build a quote-unquote fortress balance sheet like Jamie Dimon's, although he didn't add that part. The Tier 1 ratio is down. It's flat at about 11.25% this quarter. What does that tell you about the state of Bank of America's balance sheet and their financial strength, and ultimately the big issue for investors, how soon until this company can start returning capital to shareholders?
Right, that's a good question. I think most investors these days are focusing on the Tier 1 common ratio. Unfortunately, that went up during the quarter from 8.45 in the third quarter to 8.6%. And I think that's pretty well in line with the company's guidance that they will conform with the Basel III regulations as they come online, and actually much sooner than they're actually required to conform to those. So I'm not too worried about capitalization. I think the company is going to be able to build its capital, maintain solid capitalization, and conform to Basel III. Whether they return capital to shareholders in the form of a dividend in the next couple of quarters or in 2011, that's more up in the air. Right now, I'm not expecting that.
All right, Brian, one quick question before we go, and it has to be quick. Bank of America shares almost unchanged right now. Do you feel more optimistic than that on the basis of what you've seen, or a little too early to call yet?
I'm not more optimistic, but honestly, this isn't entirely different from what I expected.
Okay, so maybe the market reaction is in line with what it should be. Brian Charles of RW Pressprich. He's a debt and equity analyst, one of the most accurate when it comes to Bank of America shares. That's why he's with us here on the Inside Track this morning.